There was a signing of a ratified USMCA at the White House today. Mid-February, the Phase 1 China deal goes into effect. Have you seen business investment pick up at all? If not, what will it take to get that business investment going as this uncertainty is being cleared up?
Yeah, so I guess I'd start by saying that the fact that we've reached a Phase 1 deal with China and the fact that we've moved ahead closer to getting USMA agreed, those are potentially positive things for the economy, without question, and financial markets, the reaction of financial markets is very consistent with that perception. A sustained reduction in uncertainty over time should improve business sentiment and investment, which would provide some additional support for the economy. It's important, though, to bear in mind a couple of things. First, trade policy uncertainty remains elevated. Businesses continue to identify it as an ongoing risk. We still have 2 or even 3 active trade discussions that are going on in the public square right now. So it hasn't gone away, and we've just come through a round of talking to our vast network of contacts in the business world, and I think clearly these are seen as positive developments going forward, but there's a bit of a wait-and-see attitude. Is this going to be sustained? The agreements have to be implemented, too, and that'll take quite some time. So I would say we need to be a little bit patient about the effect on the economy. There's also the global economy. You could well see manufacturing, as I mentioned, manufacturing PMIs have started to tick up consistently among both advanced economies and emerging market economies. We do not see a decisive recovery, but it's possible that this mix of positive developments and also accommodative financial conditions could spur further growth.
Michael Derby.
Hi, Mike Derby with Dow Jones. Do you have any greater sense of what was going wrong with the repo market starting in September? There seemed to be, whether it was a one-off event, tied around tax payments and debt settlement, or whether there's a more enduring issue going on with the market, more structural forces that are basically gumming up the repo sector.
Yes, as for those forces, so as we indicated, we would undertake a serious review of that question and look at both regulations and also supervisory practices, and we'd be prepared to adjust those in ways that might encourage liquidity to flow more easily in the system, as long as it didn't undermine safety and soundness. And so we've undertaken that. We've done a ton of work. I actually don't have anything to announce here today, but I feel good about what we've learned there. I think you mentioned other factors. We will be announcing our findings. I'm not going to give you a time, but we're well along in that assessment at this time. I think we also found out, though, that the level of reserves that we need in the system to conduct our operations without frequent resort to open market operations was higher than we had thought, and it was higher than others had thought, too. We learned that we shouldn't let reserves go below $1.5 trillion, roughly the level of early September, at any point. And that means that reserves will move in a range over the course of the year that'll be substantially higher than 1.5, but they won't ever go below. So 1.5 is not a target level. It is the bottom of a range in which reserves will be expected to move.